Again, all around the world, the politicians are going to print more money. And so I see it as a completely different scenario than, let's even talk about 2021 when Jerome Powell was talking about tightening credit, when every central bank was tightening credit because of inflation. We are in a scenario where the politicians around the world, regardless of where you live, are talking about spending more money without raising taxes. And so that's why I believe that this particular cycle will extend. I think it's going to extend into 2027, 28 time period. But again, who knows how long it will go for. But as long as the politicians are going to print money to hand out goodies to people to support them, we're going to keep going higher as a crypto ecosystem.
For the first time in more than 10 years, the old playbook feels broken, and the cryptocurrency market is awash in anxiety. Every trader has a tattoo of the sacred for-year halving cycle on their brain. Officially, it is on life support. The market seems to be shouting that the game has changed forever, as evidenced by Bitcoin's erratic fluctuations, which no longer appear to be healthy corrections. The rubber band that everyone was banking on has broken due to geopolitical unrest, tightened credit, and the end of the money printer era. Arthur Hayes, the founder of BitBoy Capital, just put the finishing touch on it by saying, "The 4-year cycle is dead." His shocking conclusion was that previous bull runs had little to do with the halving. Trillions of dollars in QE from the Fed and China's stimulus firehose to 2008 recovery, COVID checks, you name it, drove these events, which were pure liquidity events. It is now a novice trap to bet naively on having go up in the absence of another tsunami of new monies. According to Hayes, we've entered a whole new era when decisions are made based on macro liquidity rather than dates. Ignore that at the risk of your portfolio. In order to avoid being destroyed by the new regulations, press the bell, slam subscribe, and like if you're done with out-of-date dogma. Watch Arthur Hayes debunk the old cycle myth and explain what truly pushes Bitcoin next.
I think that putting a definitive number on how long a cycle should be should never be done. You should always basically evaluate the circumstances and then make a decision and not be held to some sort of dogma that it has to be this way because it's been this way in the past. And because I get asked this question a lot, especially during Token 2049 a few weeks ago, I thought, okay, let me just do a little chart study, get my thoughts on paper and sort of answer this question so I don't have to keep, answering it every time I speak about stuff. And so I wrote this essay about the 4-year cycle and my view that the 4-year cycle does not apply in this particular circumstance. And how I got to that point was I said, okay, let's look at the 3 4-year cycles in the past, 2009 to 2013, 2013 to 2017, 2017 to 2021, 21 until the present moment. And can we find any patterns that sort of, roughly rhyme with each other? And obviously I have my own worldview, which is all about the quantity of money. How much fiat is there in the world? And I believe that Bitcoin specifically, and obviously crypto more down the line, is a reaction to the amount of fiat that has been created, especially since the global financial crisis in 2008. And I don't believe it's a coincidence that the genesis block of Bitcoin happened in January 2009 during the depths of the bear market. At the time when the Federal Reserve, led by Ben Bernanke at the time, restarted quantitative easing, at least in the United States context. And by that point, had already indicated that after the $700 billion bailout, the TARP bailout, that the Federal Reserve would start on unlimited quantitative easing. The markets bottomed in March 2009, and then it's basically been up only, with some minor blips from then onwards. And so if you think about Bitcoin from the first cycle, 2009 to 2013, we not only have the United States printing money, we also have China, which embarked on one of the largest infrastructure spends in their entire history in the 2008 to 2011 time period. And I showed a chart of the government credit impulse, which is the rate of change of how much credit's being created in China. And you see both America and China were printing a fuck ton of money. And of course, Bitcoin, went up a lot. Obviously, if you were trading Bitcoin in the fall of 2013, you remember the 40-50% premiums in China. I know I certainly remember that I was arbitraging it in Hong Kong at the time. And then as sort of 2013, the end rolled around, I posted a chart. You see that bank credit and Fed liquidity kind of rolled over a bit. China was not creating as much credit as they had been. And that was the pop of the first Bitcoin bubble, the 1300, whatever all-time high was reached in December 2013. The next cycle was basically driven by China. So if you were trading crypto, I remember this quite vividly back in August 2015 is when you got the $135 wick on Bitfinex, which was, a fellow named Zhao Dong got liquidated for 6,000 Bitcoin. It was a quite interesting day in the markets. And subsequent to that, within a few weeks, the PBOC did a shock devaluation of the yuan, and that really kickstarted the bull market that ended in 2017. And so China did another massive stimulus program. If you traded Chinese equities, you remember the Shanghai Composite hit an all-time high in 2015. And this was due to all this apartment spending. They did a big housing program to pump housing, and they were also doing infrastructure spending. Now, at the same time as that was happening, the US was kind of going in an opposite direction where the amount of credit was actually decreasing and the Fed was raising rates. And at a certain point, those two policies came into conflict as far as the Bitcoin price. And by 2017, that rally was exhausted and we got the $20,000 peak. And then obviously the subsequent fall. The next cycle was the COVID cycle, driven by COVID stimulus checks, especially in the United States, which is the largest government that participated in printing money to keep people locked in their houses because of the flu. China did not participate as much as other places around the world. So this is really a US story. And we all know everybody in the United States got a few $1,000s of stimulus checks. They went on Robinhood, they bought Bitcoin, they bought a car, they did all kinds of stuff with these checks. And obviously we know what happened with the 2021 $69,000 Bitcoin price. Again, driven by quantity of money increasing during COVID.
This is the agonizing squeeze preceding the largest liquidity flood in history rather than the conclusion of the bull. Arthur Hayes has completely turned the panic narrative on its head. The true story is dollar credit constricting, not Bitcoin being broken. Most traders ignore the subtle warning that liquidity is rapidly disappearing when SOFR spikes above the Fed funds rate. According to Hayes, that pressure compels the Fed to clamp down on QT and turn the printers back on sooner than most people anticipate. It's not limited to the US, though. With no intention of raising taxes, governments in Washington, Tokyo, and Beijing are preparing for massive spending binges: infrastructure, reindustrialization, defense megabudgets. Who pays, you ask? Naturally, central banks. New global money in the trillions is on the horizon. The bottom line, according to Hayes, is that after that tidal wave, the next crypto super cycle will hit hard during 2027 to 2028. And Bitcoin will not only rebound, but soar to $999,999 or more. The mother of all liquidity storms is about to arrive.
As soon as the Fed started to say, hey, hold on, there's a lot of inflation, we're going to telegraph to start raising rates in March of 2022, that was the peak of the market around that late 2021 time period. So then we move to this current cycle. And if you want to think about what's the credit event of this cycle, obviously China did not participate. China basically popped their housing market and has been dealing with a deflationary environment, is not printing enough money to counter the effects of essentially the property market going down. In America, we have the reverse repo, and that is the story of this past sort of few years. Janet Yellen, bad girl Yellen, as I like to refer to her, was tasked to juice the markets. At the same time, Jerome Powell was supposedly fighting inflation. And so to do that, she engineered a strategy whereby the US Treasury Department issued more short-term debt, Treasury bills, than long-term debt, Treasury notes and bonds. That drew $2.5 trillion of liquidity from the reverse repo program that was sitting at the Federal Reserve, pumped it into the markets, and that has been essentially the story of this particular cycle. That facility is now at zero. And so the question is, okay, well, we're at this time period where the 4-year cycle generally peaks. Is there another event that's going to create enough credit that's going to create a resumption of this bull market and get us out of this 4-year cycle thing? And I believe yes, because I basically read the newspaper and I listen to politicians. What are they telling us? They're liars, all of them, but it's useful to hear the types of lies that they're telling us. And so if you listen to politicians talking about reindustrialization, they're talking about my nation first, they're talking about defense spending. Do I ever hear the words, we're going to raise taxes a fuck ton to pay for all this? Generally not. Everybody's going to get something. It's not going to cost you anything. And how are we going to do it? We're going to lean on the central banks to print the money. We're going to lean on the fiduciaries to buy the debt that we're issuing. We're going to lean on the banking system to lend more to the right type of companies. And this is global. And so when you're in this Fed cutting cycle, they're cutting rates, even though the US economy is growing at something like 4% real GDP. Inflation is above their target. You have the Fed meeting, which is going to happen, I guess, in a few hours post this recording, where it's anticipated that Jerome Powell will stop quantitative tightening, and everyone expects quantitative easing to start at some point in the near future. China is talking about how they're going to support markets, whether it's a housing market or particular types of industry, So credit growth is going to grow in China. Japan, the new prime minister, I can't pronounce her name correctly, so I'm not even going to try. She is talking about printing money to help households pay for goods and services because of the high inflation that was caused by the printed money of the previous administration, who she loves, Abenomics. So they're printing money in Japan. And then the ECB is going to have to print more money to save the euro. So again, all around the world, the politicians are going to print more money. And so I see it as a completely different scenario than, let's even talk about 2021 when Jerome Powell was talking about tightening credit, when every central bank was tightening credit because of inflation. We are in a scenario where the politicians around the world, regardless of where you live, are talking about spending more money without raising taxes. And so that's why I believe that this particular cycle will extend. I think it's going to extend into the 2027, 28 time period. But again, who knows how long it will go for. But as long as the politicians are going to print money to hand out goodies to people to support them, we're going to keep going higher as a crypto ecosystem.
The clearest distinction between gold and Bitcoin that anyone has drawn. This cycle was just made by Arthur Hayes. The reason for gold's meteoric rise isn't inflation. Rather, sovereigns have been buying actual bars in panic ever since the United States froze Russian currency and demonstrated that Uncle Sam may seize your treasury bonds at any time. To de-risk from weaponized USD, China and others are piling gold bricks like it's 1944 all over again. Bitcoin, it's still just a credit and liquidity play. The two hard assets are drastically separated because countries aren't yet adding it to reserves. Distinct timelines and triggers. Auto-deleveraging mechanics were in the terms of service. Read the damn fine print or get wrecked. Not my problem, Hayes said, expressing no emotion in response to the October 10th cascade. On the other hand, he is putting a lot of emphasis on one horse, Zcash to $10,000. In a world of complete financial surveillance, Zcash is simply digital currency. The privacy coin narrative has returned with a vengeance, and the trusted setup has vanished. He loves his moonshots asymmetric, volatile, and illiquid. Wide-ranging alt-season hopium? Dead. Instead of thoughtless greater fool pumps, this cycle rewards selective investments on real revenue protocols, think hyper-liquid style that genuinely send cash flow to token holders. Hayes' conclusion is that while the massive liquidity flood is still on the horizon, the people who can put aside their nostalgia for 2021 and trade the real stories of 2025 to 2028 will emerge victorious. What will you do now? Will you continue to chase outdated memes or rewire for the upcoming meta and macro deluge? Let's stack sats the smart way. Leave your thoughts below, click the bell, subscribe, and slam like if this changed your perspective. Thank you for viewing.